question is if banking system liquidity is headed lower and interest rates are headed higher, is this bad for the precious metals sector? Greetings, land of Arcadia economics. Welcome to another bi-weekly episode of the podcast that I do for Chris and the gang. I probably should have some sort of name for it, like Rafi does, the end game investor. It sounds kind of ominous, if not apocalyptic to me, but his mindset's probably along the same mindset as mine is in terms of where we're headed systemically going forward, at least for a while. So, but I do have potential good news for precious metals investor aficionados, which I've been for the last 21 years. It looks like the sector might be starting to perk up. However, I have bad news for those hoping for another bull market in the stock market or the housing market or just general good times for the economy. So let's just jump into it. I try and keep this brief this week. So based on all the data that I look at, the economy is actually tanking a lot faster than is acknowledged. And I don't know if it's just the mainstream media trying to preach good times on behalf of the party in power ahead of the midterms or whatever it is. But I mean, if you look at the hard data, there really isn't any good news out there. And I'll just review a couple things. Probably one of the most interesting aspects that is not getting a lot of press, in fact, it's getting a lot of gaslighting, is the supply chain issues that we had since the pandemic lockdown are essentially over. Now, it may not be true for all items, but for most it is. And one of the signs of this that are an indication that this is the case is shipping container rates have plunged 79% from a year ago. And that's a result. It just means that there's a lot less import demand coming primarily from this country, but globally from countries that are primary exporters. So China being most notable there. Another interesting aspect or another data point that shows just how ugly things are starting to get is the end user inventories at the retail level are absolutely soaring. And we saw this with Walmart and Target when they reported their numbers. I think it was July or early August. Their inventories are going through the roof. Both of those companies canceled billions of dollars in orders. And that's, that feeds into import demand and container rates, et cetera. And it feeds into what previously was supply chain issues. And then just, I think it was last week, Nike reported their numbers and their inventory is going through the roof as well. And a lot of this is these retailers in the US over budgeted what they ordered in anticipation that the good time demand that occurred, bump in demand that occurred after the stimulus checks were sent around was going to keep going. That was going to be continuous. And obviously it isn't. It hit a wall. And unfortunately for most of you, housing is I think it's going to crash. I've said this before. I think it's going to crash faster than it did when it actually started to head south before 2008. We're starting to see listed inventory rise very quickly. I mean, it's still, inventory is still on the low end, but there's a lot of people who want to sell that are not putting their house on the market right now because the market's not where it was in June. I track what's going on in my area on Zillow very closely, and there's been a lot of listings recently that have been pulled. And part of that is people can't get the price they thought they were going to get, and they changed their mind on moving. So, and there's also evidence out there that rental rates are starting to come down, especially in what was previously some of the hottest markets where there was, there might have been multifamily housing that was overbuilt or a lot of mom and pop single family home investors who bought homes sometime in the last year and now are trying to rent them out, and they're finding that they have to lower their rents. So that's what's going on there. Auto inventories. Autos obviously had been in short supply because of supply chain issues. At the new car level, it was being affected by a shortage of chips. The shortage in chips it was gone in late July, and you're going to start to see new auto inventories go through the roof. And used inventories are also climbing very quickly. And part of the evidence of this is that used car prices, according to Manheim, have now fallen 4 months in a row. And unless you desperately need to buy a newer used car right now, I'd probably wait, because 3 to 6 months from now, prices are going to be a hell of a lot better. Just to circle back to the housing data, one of the things that I like to look at is grassroots corporate data level data. And KB Homes reported their numbers a couple weeks ago, and on a year-over-year basis, their quarterly new order rate was down 50%. And then in, I think it was July, Toll Brothers reported their quarterly numbers, and their year-over-year quarterly orders for the quarter were down 60%. And not all home builders are getting hammered like that, but they will start getting hammered. And the cancellation rates are now at most home builders are north of 20%. And in the last housing bubble, after it popped, cancellation rates got, for some home builders, as high as 50%. And I think we're going to start to see over the next 6 to 12 months, if not sooner, you'll start to see home builders reporting cancellation rates north of 30 and north of 40%. So, and a lot of this is being driven because the average household, and it's not just the average household, the above average wealth and income household starting to struggle financially. So Lending Club puts out basically a monthly survey on the financial condition of the average, of households. And the one that came out most recently, I think it came out in the last day or two, it showed that 60% of the respondents that they surveyed are living paycheck to paycheck. They're out of savings. They barely have any money left for emergencies, and they're living paycheck to paycheck. Now, what was even more interesting about that is that 45% of those earning six figures are now living paycheck to paycheck. And I think that probably has to surprise a lot of people. It somewhat surprised me, but hey, there's a lot of people earning mid six figures that live in a $1 million, 6,000 square foot house with a huge mortgage, and they have a pair of really nice foreign produced SUVs with $100,000 loans on them. And that's what's causing that, in addition to the erosion of real disposable income from the ravages of inflation. So the economy's contracting at an accelerating rate. We're seeing that in the numbers. Another interesting thing going on, and Rafi, speaking of Rafi, who does a great job covering this as part of his thesis, and he studies it a lot more closely than I do, but banking system liquidity is contracting, and that's not a good thing. It means that there's a direct correlation between the downward or upward movement in banking liquidity and reserves and deposits and the direction of the stock market and the economy. And we're starting to see that now. And this is just getting started. But both reserves and deposits are now headed lower, and they're headed lower at a faster rate than the Fed's balance sheet. And unless that reverses, it means that everything that has happened to the financial markets and to the economy since the Fed started even threatening about tightening, because they didn't really start jacking rates, I think, until, what was it, like the spring, maybe something like that. But the economy started slowing down before that, and the stock market started heading south at the beginning of 2022 for the Dow and the S&P, and in November for the Nasdaq. So the question is if banking system liquidity is headed lower and interest rates are headed higher, is this bad for the precious metals sector? And I would argue no. I mean, first of all, and I've referenced this in the past, Adam Hamilton has a study that he did. You can, use Google to find it. I have it bookmarked. And he takes the data all the way back to 1970, and it shows that when the Fed starts hiking rates and goes through a Fed funds rate hike cycle, that's correlated with the best periodic rates of return for gold. And it may be counterintuitive, and it certainly is counter to the common narrative out there, but the common narrative is based on ignorance, because all you have to do is read his article, and it's right there, it's clear. And that's just market data. It's not him interjecting, his opinions or making assumptions about what the data might have been. It's based on hard data. At the same time, and I'm sure you guys have seen this covered on a lot of different podcasts, but the data show that physical gold and silver are starting to leave the bank vaults on the COMEX and the LBMA. It's been going on for a while, and it started. I don't really follow it on the LBMA, but Ronan Manley does a great job, and he's written 2 articles recently about silver leaving LBMA vaults for London vaults, and but I tracked the COMEX data, and both gold and silver had been sort of slowly, the warehouse stocks in the COMEX vaults had started going down in the spring, and it's been happening more quickly. And at the same time, that's been correlating with the banks they've obviously gone net long COMEX silver contracts, and they've been rapidly covering their short position in COMEX gold contracts. So it's an indication that there's liquidity that's starting to be sucked out of the derivative side of the gold and silver markets, and there's also an indication that there's private entities, large and small, who want possession of their gold. And so maybe this could be what we're seeing is Gresham's law engulfing the monetary system, where bad money chases out good. People are converting their fiat currencies into physical gold and silver, and they don't want to leave it in the vaults. They want to keep it close to their own safekeeping, and that's what I recommend. So I guess the question is, getting back to the precious metal sector, it's been perky. What was interesting for me is that last week, while the market was headed south, gold, silver, and the mining stocks had one of their best weeks in many months. And prior to that, for quite some time, the precious metal sector had been trading up and down in correlation with the stock market. So is this similar to what we saw in October and early November of 2008, when the precious metal sector started going north while the stock market kept heading south? I don't know. I mean, what triggered it back then was the QE, the Fed money printing was getting started. And I think that's what kind of triggered a move higher in the precious metal sector. What this chart shows is a 1-year daily chart, and it's comparing. I'm sorry, it's not a 1-year chart. It goes from September 26th to today, October 5th, and it shows the GDX ETF versus silver, gold, and the S&P 500. And you can see the mining stocks really starting toward the end of the day, last Monday, started moving higher, while the S&P started moving south all week. This is a 15-minute interval chart, because obviously shows what's going on better than a daily chart would show. And silver shot up also toward the end of last week. And this is based on percentage moves made by these securities. So GDX outperformed everything. Silver kind of came in second, although it was underperforming gold early last week. And then obviously the S&P 500 is lagged, and it's lagged by quite a bit. And so that is potentially a bullish sign. And I'm not in the business of making predictions that this is going to continue. Part of it, could depend. If we have a stock market crash, it's going to take everything down with it. But I think that downward movement in the precious metal sector will be temporary. And it hasn't been all bad news for the mining stocks also. And one thing that I wanted to share, I hope I get this right on the sharing the screen, is there's actually been some mining stocks that have been doing well even before the start of the last Monday. Since last Monday, one of them is New Gold. And New Gold is a stock that I've covered for quite some time in my mining stock journal. And it happened to, it had a downward, well, it shit the bed in early July. And that was because it had some one-time issues at both of its mines when it announced its quarterly production numbers. And, the stock got hammered. And in the issue that followed this event, I said, look, this is irrational that the stock did what it did. The issues that affected production at both mines are going to be corrected, and probably corrected by the following quarter. And the stock was trading it was actually in below 70 cents when I recommended it. And I said, my target price is back up to at least filling this gap by the end of the year, which was at 96 cents. Well, I was wrong about that, because it actually filled the gap last week, and it intraday it traded over $1 earlier this week. So I think it closed at 96 cents. So that was my original target, and it hit that by the first week of October. So, and there's a lot of stocks out there that are like this. I've been pounding the table on Fortuna Silver, and Fortuna Silver is a stock that's irrationally undervalued right now. And I think at some point, if we're going to have a nice cyclical move higher in the sector, I think Fortuna is going to outperform. And as it turns out, a colleague of mine implored me to take a look at a junior gold company that's developing a gold mine. It's I don't know, I think it might be, it's less than a year and a half from probably its first pour. It's got a feasibility study out that just the numbers are off the charts relative to where the stock's trading, and it's just been hammered mercilessly this year since the spring. And I will be featuring that in the next new issue of the Mining Stock Journal, which will go out tomorrow, which, as you're watching this, is actually today after the stock market closes. So to tie this up, well, I think there's more bad news and worse bad news coming for the general economy, housing market, etc. I do think we're starting to see green shoots in the precious metal sector, and they're at historically or near historically oversold and undervalued levels relative to all other financial assets. And I think if you start accumulating new positions now or adding to existing positions that are beaten down, I think you'll be handsomely rewarded within the next 6 to 9 months. So hope everyone has a good weekend, and I hope some of you plan to enjoy tonight's Thursday night football game between the Broncos and the Colts. Go Broncos. And until next time, have a good 2 weeks.